I'm Andrew Moran, Liberty Nation's economics editor.
Very, very rocky.
Death by government.
Drain the swamp.
Hello and welcome to another installment of Liberty Nation's Swamponomics videocast. I'm Andrew Moran, Liberty Nation's economics editor. This week, eternal bailouts for America's banks. The Federal Reserve, in collaboration with the Federal Deposit Insurance Corporation and the Office of the Comptroller of the Currency, try to say that 10 times fast, is working on a plan to require banks, both financially sound or unsound, to take out emergency loans. Again, banks with solid balance sheets and banks with horrendous ledgers alike would be forced to tap the discount window. The discount window has been around since the Federal Reserve's inception in 1913. It is considered a last resort option for financial institutions. For the past century, even the central bank has discouraged financial institutions from accessing the discount window, and the banks themselves have been reluctant to use this lending facility since it would signal to investors that these companies are facing challenging times. So, Michael Hsu, the acting comptroller of the currency, revealed in an recent interview with Bloomberg that the purpose is to ensure the banking industry can withstand an exodus of deposits comparable to what occurred during last year's regional banking meltdown. Hsu told the business news channel, quote, "We want to make sure that banks have enough resources to meet any kind of outflows within 5 days, especially those related to uninsured deposits. It's almost like doing a fire drill. If it's required, when a real liquidity fire comes, then the banks can do it in real life." The other objective is to reduce the stigma of using the discount window. So, if JP Morgan Chase or Wells Fargo are borrowing from the Fed, it would ostensibly mask the financial difficulties that some mom and pop regional entity, whether in New York or California, is grappling with. Now, what is interesting about this scheme is that it has apparently been in the works for a while. Some Eccles building occupants even alluded to it in their speeches. Here is Michael S. Barr, the Fed Vice Chair for Supervision, talking about this very idea at a European Central Bank event in December 2023.
The discount window provides ready access to funding that can help banks manage their liquidity risks. The ability to access funding at a predictable rate through the discount window should figure importantly into banks' liquidity risk management plans under a range of scenarios. The discount window is also an important tool for monetary policy. The primary credit rate set at the top of the target range is a component for how we can achieve rate control under a range of circumstances. To achieve our monetary policy aims, the discount window needs to be readily usable. If banks do not feel free to use the discount window when private sources of funding are more expensive, the discount window will not be an effective part of our monetary policy implementation toolkit. Banks have previously said that they are afraid of receiving negative feedback from their supervisors in the event that their grounds for tapping the discount window is that it is the most convenient or cheapest form of funding immediately available to them. In light of this, we at the Federal Reserve have been underlining the point to banks, supervisors, analysts, rating agencies, other market observers, and the public through numerous channels that using the discount window is not an action to be viewed negatively. Banks need to be ready and willing to use the discount window in good times and bad. The discount window is also an important tool of financial stability because the Federal Reserve can provide liquidity in an array of circumstances, including those when other sources are impaired. These features mean that discount window preparedness provides additional diversification benefits that can meaningfully enhance effective liquidity risk management.
Did you hear this? Banks need to continue borrowing from the Fed whether the economy is roaring or it is on the brink of collapse. But how can the Fed even support the discount window when it is busy bailing out the federal government by buying Treasury securities and stimulating a slowing economy simultaneously? Here's another question. Would Fed officials reduce the discount window rate since banks would be forced to use it? This is the million-dollar question that Mr. Hsu would not answer. By the way, right now, the discount rate is at about 5.5%. So, as the nation's top financial regulators try to usher in a new era of permanent bailouts, a key deadline is approaching, March 11th, 2024. Now, why does this matter? This is when half of the Bank Term Funding Program, or BTFP, loans from the banks are due. If you don't remember, the central bank launched this lending emergency facility in the fallout of the banking crisis when Silicon Valley Bank and Signature Bank collapsed, with troubled entities receiving one-year loans from the Fed to pad their balance sheets. Today, the BTFP is at an all-time high of around $162 billion. It has accelerated since November, rocketing about 42%. Some thought it was an indicator of a banking system on the brink. However, it has been learned that some banks are exploiting the program for their benefit. I know, crazy, right? Ultimately, borrowers took funds from the BTFP to park their money in their accounts at the Fed. They're earning about 5.4% on the reserve balances, while only paying 5.1% on the BTFP's loans, so they're generating a profit about 30 basis points. Since the global financial crisis nearly 2 decades ago, any semblance of a market-based banking system has been abandoned. It has become Washington's worst-kept secret. Banks will always be bailed out, even when they make bad decisions, and then pass the direct or indirect costs to taxpayers and clients. It turns out that becoming a shareholder in the big banks is perhaps an almost guaranteed investment for traders. As Mr. Barr noted, whether good times or bad, they will be given money from the Fed and they'll like it. That's it for me this week. Please read my full Swamponomics column on the pages of LibertyNation.com, and be sure to check out my previous Swamponomics TV episodes and interviews. Thank you. I'm Andrew Moran, Liberty Nation's economics editor.
Very, very rocky.
Death by government.
Drain the